Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all into this very important webinar on consideration of laws and regulations in an audit of financial statement that is relating to the SA 250. And in order to tackle this very important topic, we are having with us our very eminent and learned speaker from our Chartered Accountant fraternity, very respected C. Anil Sharma ji. So on behalf of AASP of ICI, I extend my warm welcome to you, sir. Welcome to you, sir, in this 104th webinar organized by the most CT program organized by AASP of ICI.
Thank you.
It is my proud privilege, yes, sir. It is my proud privilege to share the brief profile of C. Anil Sharma ji with all of you. See, Anil Sharma ji is in practice for the last 40 years. He is a senior partner of Messrs. A. Sharma & Company, Chartered Accountant firm, New Delhi. He is a part-time member in National Financial Reporting Authority appointed by Ministry of Corporate Affairs, Government of India for a period of 3 years with effect from 24th of June 2020. He is adjunct faculty with an Indian Institute of Corporate Affairs set up by the Ministry of Corporate Affairs, Government of India. He is a member of Expert Advisory Committee of Institute of Company Secretaries of India. He was a co-opted member of Committee for Corporate Law and Corporate Governance of Institute of Chartered Accountants of India for the year 2020-21. He was a non-executive independent director of UCO Bank appointed by the Ministry of Finance, Government of India for a period of 3 years from 2016 to 2019. He was a special invited to committee set up by MCA to frame the company's auditor's report audit 2020. He was a special invitee to the National Advisory Committee on Accounting Standard NACAS set up by the Ministry of Corporate Affairs from 2014 to 2018. He has delivered so many lectures, so many seminars, so many webinars, virtual CP meetings during the COVID time as well as before the COVID period time, and so many branches, study circles, regional councils, as well as other chapters of ICAI, various seminars and conferences. He has given his expert opinion as a guest speaker. So list is still long. On behalf of WSP of ICI, sir, once again I welcome you, and we are fortunate enough to have your words of wisdom today, sir. Over to you, Anil Sharma, sir, please.
Yeah, thank you very much, Anilji. And frankly speaking, I must congratulate AASD for taking this initiative of organizing webinars on essays, and I've been told that this is 104th webinar. So it's really a very good, I would say, a great service which the board has done for the members at large. So as Anilji mentioned, the topic which has been assigned to me today is SA 250, consideration of laws and regulations in an audit of financial statements. I think the very title of the standard gives you a feeling that this is one standard which is now gaining a lot of importance, and especially with some amendment in Code of Ethics also, this has taken a more important place in our family of essays. So I think I would like to adopt a format today that if you have any questions in between, you can put it into the chat box. And I would suggest Anilji to raise those points in between also if he feels. Otherwise, in any case, we are going to keep at least 15-20 minutes at the end of the session for Q&A. So yeah, so with this, let me start with this topic. So let's start with the very objectives of SA 250. So if you look at the standard, it says that it has been designed to assist the auditor in identifying material misstatement of the financial statement, which might happen because of non-compliance with laws and regulations. So the objective is to help to assist the auditors in identifying those material misstatement because of non-compliance of law and regulation. And therefore, this essay deals with the auditor's responsibility to consider all those laws and regulations while he's performing an audit of a financial statement. And one exclusion which has been mentioned here, that this essay would apply only in the case of attestation or performing an audit, and not for other assurance engagements in which the auditor is specifically engaged to report separately on compliance with specific laws and regulations. For example, if he's, let's say, certifying, giving some assurance with regard to SEBI requirements, then SA 250 would not apply. This would apply only when there is a performing an audit of financial statement. This is first important point here to be noted. So since the entire gamut of SA's provision would involve around non-compliance, so let us first understand what is this non-compliance which this essay refers to. It has been defined as acts of omission or commission by the entity which is being audited, either intentional or unintentional, but which are contrary to the prevailing laws and regulations. Now, there may be a question in your mind, what are we talking, which laws and regulations we are talking about? We'll come to that a little later. But at the moment, it is acts of omission or commission, whether intentionally or unintentionally, which is contrary to the prevailing laws and regulations. And it goes further. It says that such acts include transactions entered into by or in the name of the entity or on its behalf by those charged with governance, management, or employees. So the entire ecosystem of the company, whether it is the company itself, whether it is on the name of the company by its employees, by its management, by those who are charged with governance, anybody does any act which is contrary to the prevailing laws and regulations, that would be considered as non-compliance for the purpose of this essay. Again, here also there is one exclusion. It says that non-compliance does not include personal misconduct which are not related to the business activity of the company, of that entity which is being audited, by those charged with governance, management, or employees of the company. So whatever they do in their personal capacity, which has nothing to do with business activity, will not be considered as non-compliance. So please keep this definition in mind, because this is the non-compliance of prevailing laws and regulation. When they trigger, only then this entire essay gets the other provisions of this essay start applying. So, talking about the laws and regulations. Now you can classify these laws and regulations into different categories. First is that those laws and regulations to which an entity is subject, and in fact, all those laws constitute the legal and regulatory framework. So it means those the entity is working within those regulatory framework. That one type of laws and regulations are those? I'll give you example. Second is provisions of some laws and regulations have a direct effect on the financial statements. This is the second type of laws and regulations, where the provisions of those laws and regulations have a direct effect on the financial statement. And another way to look at it is other laws and regulations which are complied by the management but do not have a direct effect on the entity's financial statement. But the non-compliance with laws and regulations may result in fines, litigation, or other consequences for the entity that may have a material effect on financial statement. So non-compliance of those laws and regulations will result into fines and litigations or consequences, because once fine is there, that has to be provided for in the books. So therefore, then it would have a direct effect on the entity's financial statement. And if there's a material effect of those on the financial statement, those are also to be considered as non-compliance with laws and regulation within the purview of SA 250. Now let us look at all these type of laws and regulations by way of an example. Take the case of an insurance company. See, as you know, that insurance companies are regulated under the Insurance Act, and then there is a Insurance Regulatory and Development Authority, which has prescribed a gamut of rules and regulations which are applicable to insurance companies. So for an insurance company, the Insurance Act and Insurance Regulatory and Development Act becomes the regulatory framework. Similarly, in the case of a banking company, the Banking Regulation Act 1949 and various directions issued by Department of Banking Supervision of Reserve Bank of India, that makes the legal and regulatory framework for banking companies. Similarly, on the similar background, then there are companies who are in the business of generation and supply of electricity. Then they are governed by Electricity Act 2003. So these three are a very good example of those legal and regulatory framework to which an entity is subject. So in fact, that is the reason why when you look at Section 129 of the Companies Act 2013, which talks about financial statement, and if you look at subsection 1 of that, it says that financial statement shall give a true and fair view of the state affairs of the company and comply with the accounting standard, and shall be in the form prescribed in Schedule 3. Then there is a proviso. It says that nothing contained in the subsection shall apply to any insurance, banking company, or a company engaged in the generation or supply of electricity. And then there is a regulatory clause also. So it means that it is very clearly mentioned here that these types of companies have their separate regulatory framework and are governed by that. And though there may be, if you look at the second proviso, it still makes some application of companies which are formed under the Companies Act. They're in addition to what the respective acts and regulations say, then if some other matters which are not required to be disclosed by them, but they are required to be disclosed by the Companies Act, are also those companies are required to disclose that to make so that the financial statements are considered as disclosing a true and fair view of the state affairs of the company. So This is just a reference of the first, that those laws and regulations to which an entity is subject, which constitute the legal and regulatory framework. Now let us look at the second category. When we say that provision of some laws and regulations have a direct impact on financial statements, effect on financial statement. So you can see here that in the case of a non-banking financial company, there can be three types of company which we can see from various directions issued by Reserve Bank of India. One is a systemically important non-deposit taking company, or it can be deposit taking company. Then there can be non-systemically important non-deposit taking companies. And then third category can be of core investment companies. And there are separate, directions issued which govern to these specific type of companies. So of course the RBI Act itself talks about their registration requirement, but these directions further specify how much capital would be required, how the income will be recognized, how income from investment will be taken care of, what are those accounting standards which would be applicable to them, how accounting for investment will be done, what is the basis of asset classification, provisioning requirement, and what are the disclosures which are required to be made in balance sheet, and what will be the accounting year, schedule, additional schedule which is to be attached to the financial statement, which are prepared as per Schedule 3 to the Companies Act, and then other directions with regard to loans against own shares. So you can see from these different type of regulations that these the type of companies are their entire business, their disclosures, their presentation is totally modified by the directions which has been specifically issued by Reserve Bank of India. So I would say that you can see that these are the provision of some laws where these have direct effect on the financial statement of the company. I can give you another example here. If you look at the under the MSNE Act, it's very interesting provision there also. If you look at Section 15 of the MSNE Act 2006, so then it talks about liability of buyer to make payment to MSME, who is a registered MSME entity. Then the rate of interest which is payable if the amount has not been paid, how that amount will be recovered, and what will happen to unpaid amount with interest in the annual statement, how that is required to be disclosed. And Section 23 itself is actually talking about a provision which should have been otherwise in the Income Tax Act. It says that interest not to be allowed as deduction from income. So MSNE Act is referring some provision which is to be, and similarly Section 15, 16, 17, 22 has direct effect on the financial statement of the company, which is otherwise preparing its, preparing and presenting its financial statement as per the Companies Act. And Section 24 is important to be highlighted here. And why these sections are important, because the Act itself says that Section 15 to Section 23 are having overriding effect. And whatever inconsistent has been contained in any other law for the time being in force, Section 15 to 23 would prevail over other provisions. So Section 24 gives that kind of overriding effect, and therefore you can see that the provisions of MSNE Act have a direct effect on financial statements of a particular of any company which has any dealing with the MSME Act. And in fact, in the Companies Act itself, a lot of provisions has been incorporated, though it was flowing from MSME Act. So corresponding provisions has also been made in the Companies Act, or they have been incorporated in Schedule 3 itself, which is the format for financial statement for the companies. Another example of laws and regulations which have a direct effect on the financial statement, we can now talk about all the labor laws. As you know that with effect from 1st July 2022, new labor code has now been, labor laws has been brought into operation, which is Code of Wages 2019, Code on Occupational Safety, Health and Working Conditions, Code 2020, and the Code of Social Security, and the fourth one is the Code of Industrial Relations 2020. Now, all these provisions, if you look at that, like Code of Wages, payment of wages, payment of bonus, payment of minimum wages, and all those are now governed by this particular code, and therefore directly affect the financials of a company. Similarly, the expenses which are required to be incurred on safety, health, and working conditions, that is also governed by Code of Occupational Safety, Health, and Working Conditions. And company has to spend amount to comply with those. And all these acts and have provisions where non-compliance, there are penalties, there are heavy fines on the companies also. Then Social Security, maternity benefits, all those are also covered by Code on Social Security. And similarly, industrial disputes, employment related matters are governed by Code on Industrial Relations. And as you all know that all these acts, all these activities within the labor definitely have direct impact on financial statement of a company. So this I would say is the second type of category which we were just talking about. Now let us look at another set of rules and regulations which may result in fines if they are not complied with. Then they may result in fines and there may be some litigation or other consequences for the entity which have material effect on the financial statement. So I would personally like to put a FEMA related Foreign Exchange Management Act and rules and regulations relating to that into this particular category. Because if it is a current account transaction and it is governed by Foreign Exchange Management Current Account Transaction Rules 2000, and if there is a foreign exchange involved into it, similarly as about the foreign investments, Indian investment abroad, and export of goods and services, borrowing and lendings, debt instruments, overseas investments. There are all these have specific rules and regulations. And if companies do not follow that, then there are very heavy penalties. I mean, in general, we can say that FEMA has 3 times of the amount involved. And then there are, of course, provision of compounding in the Act. So it means that non-compliance will result into fines. There can be litigations. You must have seen especially in the case of export and import of goods and services. Almost all companies who are into this type of activities where their businesses have something to do with import and export, there are, if they don't comply with the respective regulations, then there are fines and penalties, litigations, sometime adjudication from the enforcement directorates, and then sometimes they have to go to the for the compounding, and so many. I mean, in some cases where the money has come in and has not complied with, let's say, non-debt instrument rules 2019, that money has to be paid back. I mean, has to revert back. So that transaction nullifies. So it's a very, very important rules and regulations, and non-compliance of that will definitely have a material effect on financial statement. So I would put this into the third category, this FEMA various rules and regulations there. So three types of laws and regulations. So let's move further. Primarily, the responsibility to comply with the rules and regulations is that of the management. They have to, those who have been charged with governance, they have to ensure that entity operations are conducted in accordance with the provisions of the law and regulations that determine the reporting amounts and disclosures in an entities. And in addition, if there is any non-compliance and then some penalties are imposed, those are also required to be accounted for and has to be taken into account. So it is the responsibility of the management to comply with that. And how management normally does that? So they have management normally does that by putting policies and procedures in place which assist them in not only prevention of non-compliance, but also detection of non-compliance with the law and regulations if it happens in spite of taking a lot of preventive measures. And some of the steps which you can see, which normally companies are supposed to take to discharge their responsibility for compliance with the rules and regulations are first can be the maintaining a register of significant laws and regulation with which the entity has to comply with in particular industry, and then keeping a record of complaints. So monitoring legal requirement, ensuring that operating procedures are designed to meet these requirements. So the check and maker and checker type of inbuilt systems are built in the operating procedure itself to ensure that those legal requirements are complied with and there is no non-compliance. Then they can also institute a appropriate system of internal control there. They can also have a proper developed code of conduct, how the employees will be carrying on their duties while complying with ensuring that there is no non-compliance with any laws and regulations. Training the employees can be another way which management normally takes care of. Then monitoring compliance with the code of conduct and acting appropriately to discipline employees. So once the code of ethics has been explained to them, they have been trained to understand that, and even then after somebody has been found that then taking a legal disciplinary action against those that should also be a part of the process. And similarly, the companies can also engage legal advisors or maybe third-party validation in monitoring legal requirement. They can engage, and this is again a very common practice these days, which management resorts to ensure that there is no non-compliance with the rules and regulations. And in the case of a bigger companies, you can see that larger entities normally in their internal audit function itself, they built in the internal audit program itself is designed in such a way that all the policies and procedures are duly verified by the internal auditors or internal audit division there. And in the case of audit committee's mandate also has one of these important agenda that they have to ensure, they have to monitor that the management has complied with all the laws and regulations, and they have to take reports from various departments or see whatever segments are there and their respective laws and regulations which are applicable to taking a report from them that they have been. So that is in addition to internal audit function. Sometimes audit committees also look into this aspect, and then it can be a compliance function within the entire internal control system of the company. So this is another way where management discharges its responsibility for complying with laws and regulations which are applicable to them. Now coming to the auditors part now, because ultimately we are SA 250 is more concerned with the auditors. First of all, it is a important statement that non-compliance with by the entity with the laws and regulations may result in material misstatement of the financial statement. I think the examples which I gave you, those properly establish that there can be material misstatement of financial statement if the respective laws and regulations are not complied with, or if there is a non-compliance of that. But there can be a technical side of it. Whether an act constitutes non-compliance with laws and regulations is a matter of legal determination, which normally we say that it is not the auditor is not professionally competent to determine that. I mean, it's a very, once again, a very common example can be whenever, let's say, auditor feels that, there is some problem with the labor laws, you say that you better get this thing verified from the expert in legal law, in labor laws, but we feel that there is some problem is there. So, but over a period, this is also established that auditors' training, experience, understanding of the entity and its industry or sector, that entire thing helps the auditors to at least understand, to at least get attention that there may be some non-compliance with laws and regulations. However, auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance with all laws and regulations. That is not the case. That don't stretch this SA 250 that auditors is now expected to detect non-compliance with all laws and regulations. He has to link that to material misstatement. All those laws and regulations where non-compliance result into material misstatement, those are the one which auditor has to really look at and take care of. In fact, these days there are a lot of statutory requirements which are now have been specifically asked by the auditors to report as part of their audit of a financial statement itself. And you must have seen the latest version of Companies Auditors Report Order 2020. There are a lot of new requirement where auditors are now required to report on compliance of provisions of different laws and regulations. And and sometimes furthermore, where there are specific statutory reporting requirements, it may be necessary for the audit plan to include appropriate tests for compliance with those provisions of the law and regulations. So it means that what we are trying to say here, that once it is there that auditor has to, for example, suppose there is some reporting requirement in CARO to report on a particular issue. Let's say in the case of a deposit of ESIPF contributions as part of the statutory dues, there is a specific requirement. So it means then to get the detail of that, to assess whether there is any material misstatement because of that, the auditor has to build in that verification or that checking into its audit plan, and has to incorporate those appropriate tests so that he can ensure that whether there is a compliance or non-compliance with the provisions of laws and regulations. And in some audit engagements, specifically those relating to audit of government ventures undertakings, there may be additional audit responsibilities with respect to the consideration of law and regulations which may relate to the audit of financial statement or may extend the other aspect of the entity's operation. This has also been seen in various audit of government ventures and undertakings, where they are required to report additionally on certain matters which has been prescribed by those administering ministries, those who are governing those particular companies or undertakings. So auditor is now then auditor is required to report on those provisions also, whether there is a compliance or non-compliance. That would also form part of this SA 250 itself. That's the point which is required to be understood here. So as I was mentioning, look at these are some of the examples where specific statutory requirements has been auditors has been asked to specifically report. For example, there is a new clause 3, para 3 clause 1 and subclause E. Now auditor is required to report now whether any proceedings for holding any Benami property under the Benami Transaction Prohibition Act 1988 has been initiated or pending against the company. So it is virtually the requirement which is there in the Benami Transaction Prohibition Act, and the regulator must have thought fit that because this is an important area which can really impact the true, fair and view of the state of affairs of the company, and therefore they want auditors to report on it. But definitely this is emerging with respect to another law, which is Benami Transaction Prohibition Act. Similarly, Para 3, Clause 7A and B, where auditors are required to report very specifically whether the company is the regular in depositing undisputed statutory dues, which includes GST, income tax, then ESI, PF, cess, and other charges which are which are considered as a statutory dues, whether they have been deposited regularly or not, and if there is any dispute, and what are those details of those disputes and amount involved in those disputes, and where that dispute is pending at this stage, are also required to be reported by the auditors in their report itself. Another example is, you see, some disclosure with regard to Income Tax Act. See, you can see here, Para 3, Clause 8. Now, here is saying that if any transaction which has not been recorded in books but has been surrendered or disclosed as income in the tax assessment under the Income Tax Act during the year, whether that has now been properly recorded or not in the books. So that is also required to be reported. See, you can, from these paras, you can easily make out that, in fact, these requirements are helping auditors to comply with SA 250. Because these are those which are important. Like similarly, like you can see here also that income tax, if there's some amount has been surrendered, disclosed as income, how it has been dealt with in books of accounts. There are some other examples. Now look at this. If the company has raised money by way of IPO or FPO, and for what purpose they have been used, that is basically requirement with regard to SEBI and other LODR regulations, which are issued by SEBI. But auditor is required to report that. So whether there's a non-compliance of those provisions, because money has been raised for specific purposes, whether they have been applied for that also. So this is again a very good example of that. Similarly, you can also see in Para 3, Clause 16, then there are all A, B, C, D, 4 clauses are there, which are very specifically talking about registration of a company if they are required to be registered under the RBI Act to carry on NBFC activities, whether those conditions have been complied with, whether if it is a core investment company, whether all the conditions which are required to be complied with to be considered as a core investment company, they have been complied with or not. So very specifically on reporting on other acts. So these are some of the good examples which I could give. And the second part of it, which is some reporting is emerging from by the auditors from other acts. One of the good example of that is, see, is non-banking financial companies auditors report directions 2016. Now, if you look at this, now these directions require the auditors to submit additional report to the board of directors. And this report is to be given to the board of directors of the company. And there are some specific matters which auditor is required to report to the board, whether registration has been done, whether any deposit has been taken or by the non-deposit taking and non-compliance of that. If returns have been filed in time or not, whether in the case of a non-deposit taking, and whether proper board resolution has been passed, and all these type of reporting on specific matters. You can see those in that act. So that is a specific report to board of directors. Similarly, if there is a non-compliance by the company with regard to provision of Chapter 3B of RBI Act, which is relating to the registration and creation of reserve fund and keeping the liquidity ratio, maintaining the liquidity ratio. Similarly, in the case of any non-compliance of systemically important non-deposit taking company and by the deposit taking company directions 2016, and third set of directions, which is for non-systemically important non-deposit taking companies, any non-compliance of that, auditor is not only required to submit the report to board of directors, but then they also have to send a exceptional report to the Reserve Bank of India. There is a specific format for that, and then auditor has to do that. So you can see from various examples which I have just mentioned to you that these are, in some areas, laws and regulations are important law and regulations are required to be complied with the company by the entity. So some of them, in some of those cases, non-compliance has been specifically asked to be reported by the company itself, and some of them are by the auditors, and some of them by the auditors to those respective regulators. So this type of compliances you can see with regard to laws and regulations which are applicable to the within the framework of which the company operates. With this background, let's move further on to understand what is the objective of SA 250. First of all, SA 250 makes a very clear-cut distinction of auditor's responsibility in relation to compliance with two different categories of laws and regulations. For the first category, so two categories, I'll explain you what are those two categories. First, let us understand the objective. First, for the first category, because of the nature of or the veracity of those laws and regulations, auditors' responsibility is to obtain sufficient appropriate audit evidence about compliance. So, and in the case of other category, which is the second category, auditor responsibility is limited to undertaking specified audit procedures to help identify non-compliance with those laws and regulations that may have a material effect on the financial statement. So these, I would say that this particular slide, whatever 2 points which I am making, are the gist of this particular standard. In the case of first category, let's first go about what are those categories. Then this would be easier for us to come back to this slide and understand again. So first category of laws, what are those? The provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement. I mean, examples has been given such as tax and labor laws. And I have given you some more examples earlier. So they could include those that relate to form and content of financial statement. See, for example, the first example which I gave was banking companies, insurance companies, and electricity companies. because the form and content of those companies are given by their respective, so that is by their respective laws. So that is one. Industry specific financial reporting issues. The example which I gave was about NBFC companies, accounting for transaction under government contracts, accrual of recognition of expenses for income tax on retirement benefits. These are some examples which are given, and I have already given you a number of examples there earlier. So these are first categories of laws and regulations. And then in addition to that, there may be some matters which are relevant to specific assertion, while others may be relevant to the financial statement as a whole. For example, the required statement constitute a complete set of financial statement, that is right, and some relevant to specific assertion, for example, the completeness of income tax provision. So these laws and regulations may deal with specific assertion, or they may deal with the whole financial statement as a whole itself. They can be impacting that. So these are this type of laws and regulations would be considered as first category, and in that laws and regulations generally recognized to have a direct effect and disclosure required. So in this situation, the auditor responsibility is to obtain sufficient appropriate audit evidence about compliance with the provisions of those laws and regulations. And if any non-compliance is or suspected non-compliance is noticed, then how to respond appropriately, that is also given in the SA 250 in later paras that I will explain. The second category of laws and regulations, these are those laws and regulations which do not have a direct effect on the determination of the amount and disclosure in the financial statement, but compliance with which may be fundamental to the operating aspects of the business, to an entity's ability to continue its business or to avoid material penalties. Non-compliance with such laws and regulations may therefore have a material effect on the financial statement. So, I think I have also given you some examples, like in the case of NBFC company, if they are not registered, so it may they can carry on their, if they have carry on their business of lending money, and then the direct effect on determination of amount is may not be impacted, but the company itself cannot act without registration, so that the material effect, so the entire the substance of the business itself is impacted, and therefore have material effect on financial statement. So therefore all these type of laws and regulations fall into second category of law. So in this situation, what auditor has to do in this second category, I think this is another example which I've just mentioned. So in this case, what auditor has to do, auditor has to undertake specified audit procedures to help identify what are the non-compliances, and then and if there's any material effect on the financial statement, then consider them and respond with regard to the non-compliance or suspected non-compliance accordingly, as further elaborated in SA 250. So primarily, going back to this particular slide, which I just mentioned in the very beginning. So first category, the auditor responsibility to obtain sufficient appropriate audit evidence. So I am sure that other essays you are fully aware, which are to be taken care of to address to this aspect, how to obtain sufficient appropriate audit evidence about compliances. And in the case of a other category, which is the second category, the auditor is required to undertake specified audit procedures to help identify non-compliances. So there are specified audit procedures which they are required to apply, and it is in fact slightly, I would say, little more specific than in the first category, which is general in nature and has to take care of the entire gamut of generating or creating or identifying audit evidence about the non-compliance or compliance of the provisions of those laws and regulations. Now, with this background, let us now come to some specific requirements of SA 250. After understanding what are the categories of compliances or non-compliances of laws and regulations, then SA 250 has bifurcated the entire process into 6 steps. The very first step is auditor's consideration of compliance with laws and regulations. What auditor has to do with regard to compliance with laws and regulations. And the second is, it means that understanding what are those laws and regulations which are going to be applicable. And the second is, what are the audit procedures when non-compliance is identified or suspected. Third, reporting of identified or suspected non-compliance to those charged with governance. Creating a documentation of the first 3 steps, that how they considered it, how they noticed, identified non-compliance, and how they have, reported to the those charged with the governance, documenting that. And then comes the next 2 important steps, which are reporting non-compliance in the auditor's report on the financial statement. So that decision has to be taken by the auditor after looking into the level and the gravity of the non-compliance, and then its impact on the financial statement, and then making a suitable report under SA 705, or giving a qualified report. And then finally, the last step of SA 250, which is a very important step and will lead us to another important area, is the reporting non-compliance to regulatory and enforcement authorities. So let us quickly go through all the 6 steps. Nilji, any question in between? Okay, I think at the moment there is no question. Maybe we'll take at the end. So first is auditor's consideration of compliance with law and regulations. Here there are 5-6 steps, which, or rather there are 5 steps which auditor has to take in this particular aspect. As part of obtaining an understanding, and what auditor has to do, understand the entities, its environment, and for that you have SA 350. Then it will give a general understanding of the company, that what are those legal and regulatory frameworks which are applicable to the entity, and which industry it belongs to, what are the sectors in which this entity operates. and how the entity is complying with that framework. Another example can be, let's say the auditor is carrying out a audit assignment of a share broker company, a company which is into share broking. So then it means then once he sees that the company is into share broking, then what are all those laws and regulatory framework which are required to be complied with, whether they are registered with the SEBI, what are those, how the business is transacted, what are the regulations with regard to carrying out those businesses or carrying out various transactions, what transactions they can do, all those. And then once he then has to see that how entity is complying with that framework. Because ultimately, as I mentioned to you in the beginning itself, that the primary responsibilities of the management or those charged with the governance, that they have to put a framework in place or a system in place where the legal or regulatory framework is complied with. So auditor will look into what they have done, what are those steps which they have put in place, what are those checks and balances which has been put in place, so that companies or employees do not do any non-compliance of any rules and regulations. Once it has seen it, then the auditor shall obtain sufficient appropriate audit evidence regarding compliance with the provision of this law, which have a direct effect on the determination of material amount and disclosures in the financial statement. So it means once it has how the entity is complying with the framework, once that exercise is done, it will come out, were there any non-compliances, and then auditor has to link those non-compliances with the impact on amount and disclosure in the financial statement, and then also determine, are those material, whether those amounts are material, whether the disclosures are required material, which has not been complied with. Third step would be, auditor has to perform some specific audit procedures to identify instances of non-compliance with the other laws and regulations, and linking that with the material effect on the financial statement. And those two very important steps which are mentioned here is inquiry from the management, whether appropriate, wherever it is appropriate, from those charged with the governance, either from the management, or whether the entity is in compliance with such laws and regulations. So first is that asking them, "Aap hi bataiye, have you complied with?" Inspecting correspondence, if any, with the relevant licensing or regulatory authority, because most of the time, if there is any non-compliance, since the regulatory authorities or licensing authorities always keep a close watch on all their constituents, so any correspondence sometimes also give a feedback to the auditor that whether there is any non-compliance which has a material effect on the financial statement. Third, or rather fourth step would be, auditor will remain alert during the entire audit procedure, and he will keep his eyes open to see whether there is any non-compliance or suspected non-compliance with laws and regulations to the auditor's attention. For example, if let's take a company has done some exports, has given some advance for import, and that amount has not get converted into the actual receipt, what has happened to that amount. So you are looking into a transaction, but you are then also trying to catch whether there is a non-compliance of specific regulation relating to import of goods under FEMA. So that type of, so sometime reading minutes, inquiring the entity's management, in-house legal counsel or external legal counsel concerning litigation, then performing substantive tests to detail of class of transactions, account balances or disclosures. These are some audit procedures which has to be taken by the auditors to, and finally, in the very first aspect of determining, the first last step would be the auditor shall request management and will ask them to give a written representation that all known instances of non-compliances or suspected non-compliances which he has noticed are actually such. Because you see, once you discuss with them, there may be a different angle to it. There may be some different background of those transactions. So once the management or those charged with the governance explain, giving the written representation that why this non-compliance, why there is a suspected non-compliance. They will say, either they will say, yes, this whatever you have noticed is correct, and this is a non-compliance, or they will give an explanation which auditor has to really relook at it and then decide whether the non-compliance or suspected non-compliance, which he was visualizing at the initial stage, whether it is still there or not. So that's why the further explanation can be that though written representation do not provide sufficient appropriate evidence on their own, and accordingly do not affect the nature and extent of other audit evidences that is to be obtained by the auditor. So simply relying on written representation will not help the auditor to discharge his responsibility. He may have to look at some additional audit procedures to really satisfy himself that though the written representation is given in such particular way, but if his other audit evidences suggest otherwise, then he has to do something more than simply relying on written representation. The second step, which I just mentioned initially, was that the second step would be the audit procedures. What are those audit procedures? When auditor has seen there is a non-compliance and he has identified those, or those are suspected non-compliances. So then, first of all, as soon as he has understand that, he is aware of this information concerning, then he has to further go deep into it. And non-compliance, simply non-compliance, one instance may not lead to any final conclusion for him to take to create a audit evidence. Then he has to understand the nature of that particular act and the circumstances in which it has occurred. And then he would collect or evaluate further information, whether which has been received as a response from management, or he may look at, is it a stray transaction? Is it a systemic issue? What is that? And if it is happening occasionally, it is a regular feature. So all those aspects would also has to be seen before any further step is taken by the auditor. The second step which he would take in this aspect would be the auditor will disclose the matter. Once he has seen this, then he will disclose that to the management and those who charge with the governance, as the case may be, and then ask for their response or their reaction to or their reply to his observations. So that, he should be very clear, because this subsequent processes are very, very important one. And before auditor really goes into that, whether it's a qualification or whether it is informing the third party, all those are very important aspects of SA 250. So just to come to that type of conclusion, auditor has to be doubly sure that what the way he is understanding those non-compliances, whether management or those who charge with the governance are on the same understanding that yes, whatever auditor is suspecting that this is a non-compliance, they are also concurring to that. If not, then sometime auditor may not get a clearer picture from even the explanations are not helping him to really to establish finally whether this is a non-compliance. Then even if he has to take a legal opinion, legal advice from outside, then he should do that. And finally, if sufficient information about cannot be obtained, then auditor shall evaluate the effect of lack of sufficient approved evidence on the auditor's opinion. So this is I would say, the last resort. Then accordingly, he may think of giving a disclaimer or sometime even a adverse remark if the sufficient information cannot be obtained by him in spite of his best effort, whatever steps which you have just mentioned. Then once the auditor has evaluated that, then he would then test this non-compliance on the risk assessment parameter, and then would also look into the written representation which has been received, and accordingly take appropriate action. There are in the essay itself, there are some very interesting events or matters which are indicator of the fact that there may be non-compliance with laws and regulations. And these are very good, and in fact, this helps auditors to built into their audit procedure itself, that if it is found that there are some investigation by regulatory organizations or government departments, or payments of fines and penalties are there, that would definitely will raise a doubt in the minds of should raise doubt in the minds of auditor that yes, there is some non-compliances there. That's why this investigation has happened. Unusual payment towards legal and retainership fees is again an indicator. What are those cases which are happening? For what this such big payment or this type of payments has been made? Why you have retained a particular type of legal support? So that would lead to some more information on the litigation as well as the suspected or non-compliance with the laws and regulations. So similarly, there can be adverse media comments. There can be unusual transaction with companies registered in tax havens. These are some indicators. Payment for unspecified services or loans to consultant, related parties, employees or government employees. This is again a very important point, because a number of times it has been seen that companies are not doing directly something which is against the law, but they are using consultants, third parties, or even employees to do that. Payments without proper exchange control documentation is another indicator. Existence of an information system which fails, whether by design or by accident, to provide an adequate audit trail or sufficient evidence. So sometimes this happens that they create a situation where the audit trail is, auditor is not able to see that, and therefore not in a position to generate sufficient audit evidence. So that is again an indication that there might be a non-compliance with laws and regulations. Unauthorized transaction of or improperly recorded transactions are also such indicators. So just to conclude that these type of matters which has potential financial consequences of non-compliance include the imposition of fines, penalties, damages, threat of expropriation of assets, enforced discontinuation of operations and litigations, whether the potential financial consequences require disclosure, whether the potential financial consequences are so serious to call into question the fair presentation of financial statements, or otherwise make the financial statement misleading. These are some of the matters the auditors will evaluate to understand the possible effect of all those non-compliances which has been noticed, and then only he will move to the next level. And another very important angle to this evaluation process is the auditor has to depend on the relationship of the perpetration and concealment, if any, of the act to specific control activity and the level of management and employees involved, especially implication arising from the involvement of the highest authority within the entity. The most of the time, this is the most difficult part to really, to where getting audit evidence will be difficult, is that when a specific control activity has been violated or has been vitiated by those who are supposed to control that itself, or sometime involvement of the highest authority within the entity, maybe at the board level or maybe at the MD level. So this type of, there is a very clear-cut example, all these big frauds where we have seen that whenever there was involvement of highest authority, then it was difficult for auditors to really collect really difficult to have sufficient data to evaluate the real impact of those non-compliances. Okay, after all these exercises, once the auditor has gone through it and has decided, yes, he has identified that there is non-compliance or the suspected non-compliance is there, then what he has to do is shall communicate with those charged with the governance involving non-compliance that he has this is like a final communication to them. Yes, that he has now finally reporting to them that he has decided that this is from auditor's point of view, these are non-compliances, and he is going to deal with them accordingly. So, but informing those who charge with the governance and the management about it. Then after it has been discussed with the with those who are charged with the governance, then sometime if they have any explanation, that explanation may be an additional audit evidence for the auditor. Then and sometimes it is always a good, once it is discussed, then in what circumstances those non-compliances happened. If that explanation is given, then the reporting in that particular manner is always gives a better picture of non-compliance, that under what circumstances and why that has happened, what events led to that possible non-compliance with the law and regulation. That is also becomes like a additional audit evidence. And finally, if in the auditor's judgment, the non-compliance is believed to be intentional and material, the auditor shall communicate, and then accordingly, the management itself is involved into it, and they are not going to respond to it, then he shall communicate the matter to the next level of authority. And for example, in the case of a maybe audit committee, or maybe to the board itself, and and still he feels that he doesn't feel that to whom he should be communicating, since all of them are, let's say, involved, then may consider the need to obtain a legal advice how he should be dealing with that. The fourth step out of that six steps which I mentioned, fourth is the documentation part. So all the three processes which are mentioned, auditor would be recording them, would be putting them into as a part of his audit documentation, whether it is the copies of records of documents, whether it is minutes of discussion held with management, or those charged with the governance, or parties outside the entity, or even if a legal opinion has been obtained by him. So even that becomes the documentation part of it. So after the documentation part has been done by the auditor, then he would be looking at reporting those non-compliances in the auditor's report. Whether he has to qualify, or what he has to do with it, give a qualified report, give an adverse opinion, or a disclaimer, that all depends on his judgment, and also the gravity of the non-compliance as per his assessment. If the auditor is precluded by management from obtaining sufficient appropriate audit evidence, then, as I mentioned to you, he may give a disclaimer of opinion also. So similarly, SA 705, he can examine all the three: qualification, disclaimer, and adverse. So these type of three things will depend. So I think 705 will help him in this reporting part. And the final part of SA 250, which is I would say the most important and the most relevant this time, is reporting non-compliance to regulatory and enforcement authorities. Now, SA requires that if auditor has identified non-compliance, or he's suspecting non-compliance with laws and regulations, then he has to take a call even after he has reported that in his main report, whether he should be reporting it to regulatory or enforcement authority or not. So for that purpose, to achieve or to make that particular decision, auditor has to weigh two, three things. One is whether by doing that he is going to maintain the confidentiality of client information, and whether he would be not maintaining that confidentiality, confidentiality of client information. And then also he has to look at the legal responsibility of the auditors under different laws and regulations, whether this legal requirement supersedes or overrides the confidentiality relationship of client's information which he has, whether that act overrides it or not. And then also he has to also look at, under the present legal and regulatory framework, whether a statutory duty to report the occurrence or suspected occurrence of non-compliance with law and regulation to supervisory authorities. So it means then all these decisions has to be taken by the auditors after considering these aspects, confidentiality aspect, legal requirement, and based on that, and then gravity of the situation also. And very interestingly, if you come to section 12 of section 143, at least in the case of fraud, now there is a legal requirement, because the act requires that if an auditor in the course of performing his duties as auditor has reason to believe that an offense of fraud involving such amount as prescribed has happened, then he has to inform to the central government. And as per the rules, Rule 13 of the company's audit and auditor rules, depending on the amount of involved in the suspected fraud, offense of fraud, if it is 1 crore and above, then he has to go to the central government. And if below that, then he has to report it to the board of directors of the company. Before reporting to the central government, again, he has to first inform to the audit committee or to the board, and after seeking their reply and observation, if within a time frame of 45 days, and then along with their reply and observation, then file with the central government. And if it is of a lesser amount, then board can, and see the description of the matter, which is there is the nature of fraud with description, approximate amount involved, and parties involved. That type of very clear-cut information is required to be given. And very interestingly, it is not only to the central government, but now in the reporting requirement under para 3 of clause 11 of the company's auditors report order 2020, auditor is now going to further report to the because this report is to the members, so it means to members as well as to public at large, whether any fraud by the company or fraud on the company has been noticed. If yes, the nature of the amount involved is to be indicated. Whether any report under subsection 12 or 143 has been filed by the auditor in form ADT 4, then that aspect, that fact is also required to be mentioned. And of course, about the whistleblower complaints. So this type of information not only goes to the authority, but also is now so far as fraud is concerned. So fraud is definitely covered, so to that extent, SA 250 is virtually to the extent of fraud, it is already made applicable through the reporting requirement under section 143(12) as well as through the CARO 2020. And then coming to the and similarly, I mean, there's one very interesting aspect, a new issue which has been brought in the CARO 2020, is about the resignation of auditors. So what was happening that very conveniently, and not very conveniently, in fact, due to the circumstances, sometimes auditors looking into the client's relationship and looking into the confidentiality aspect of it, non-compliance with laws and regulations, they were actually to avoid report, or not, I won't say that avoid, to not go into the reporting aspect, they were resigning from the auditorship of those companies. So this was noticed, and this was noticed by the government, and therefore a subsection 2 of section 140, which provides that now that auditor who has resigned from the company has to file the form, and then this form shall also indicate the reason and other facts as may be relevant with regard to his resignation. So it is not simply the resignation. So resignation cannot be an easy route for the auditors. And in fact, in CARO, para 3 clause 18 has asked the new coming auditor to very clearly mention whether there has been any resignation of statutory auditors during the year. If so, whether the auditor has taken into consideration the issues, objections, and concerns raised by the outgoing auditor. So it means the outgoing auditor has to communicate what are the issues, whatever the objections, whatever the concerns which led to his resignation, and the new auditor, whosoever is the incoming auditor, has to take care of all that aspect. So that is very important, once again, a very important amendment, which I thought to discuss along with the SA 250. Another aspect to SA 250 is now coming to our, amendment in the Code of Ethics, which is section 360, no clerk, in short we call it, non-compliance with law and regulation, which is again now through the whatever is there in SA 250 is also now coming through the Code of Ethics. Let me quickly explain you. If you look at this particular no clerk provision, in fact, this has been done by the International Ethical Standard Board of Accountants, and they have seen no clerk as a very important role of the auditors in fighting against frauds, money laundering, and corruption. So they are feeling it, they are taking this credit that for the first time they have permitted to the auditors to set aside the duty of confidentiality under the Code of Ethics to disclose no clerk to appropriate public authorities in certain circumstances. So this is something very, very important. And in fact, after the IESD, that standard which has been issued by them, this our institute has also revised the Code of Ethics, and section 360 has been brought into it. But for the time being, it is clearly mentioned there that the professional accountant might encounter or made aware of non-compliance or suspected non-compliance during the course of audit engagement of listed entities. So for the time being, it is in the course of audit engagement of listed entities. But if you look at the entire structure of section 360, it is a true reflection of SA 250. So section guides the accountant in assessing the implication of the matter and possible course of action when responding to non-compliance or suspected non-compliance with the laws and regulations, which are recognized as having a direct effect on the determination of material amount and disclosures. Even language, you can see, is virtually the same as given in the essay. So other laws and regulations that do not have a direct impact, but might have a fundamental to the operating aspects of the client's business, to its ability to continue business and to avoid material penalties. But when you go through this 360 further, it gives you some more clearer picture. In fact, this will help you in applying essay 250 also. So it says that while responding to non-compliance or suspected non-compliance, the objective are to comply with the principle of integrity and professional behavior by alerting management. This is the objective of they are trying to explain, that enabling them to rectify, remediate or mitigate the consequences or deter the commission of the non-compliance where it has not yet occurred, and to take such further action as appropriate in public interest. This public interest aspect is important. Non-compliance, section 360 has also defined non-compliance, which is virtually the same as non-compliance has been explained in essay 250. So non-compliance, if we look at this definition, non-compliance comprises act of omission and commission, intentional or intentional, which are contrary to prevailing law, and committed by a client, those charged with the governance of a client, management of a client, and other individuals working for or under the direction of the client. In fact, other individuals working for and under the direction of the client is a broader term. It is not simply covering the employees and consultant or something. Even I think under the direction of a client, it sometimes makes covers a bigger area. And then examples which are given, that is very interesting. So section 360 gives, now you can see this into the other aspects into essay 250 also. So fraud, corruption, and bribery. I mean, these are specific. All these are specifically governed by laws and regulations. Corruption, bribery, money laundering, terrorist financing, proceeds of crime, security markets and trading, whether it's insider trading or some kind of a parallel trading, what different practices are there. Banking and other financial products and services, data protection, tax and pension liabilities and payments, environmental protection, public health and safety. So at least these examples give you an idea that what are those tax, the laws and regulations which are also covered in addition to those laws and regulations which are the regulatory framework or sometimes are directly impacting the financial statement of the particular company. One very interesting point which is given in section 360 is also that if the professional accountant becomes aware of non-compliance, first of all, two things are to be seen. One, when we say professional accountant, this definition covers auditors as well as a chartered accountant who is employed with the company or who is into the part of the management or part of those who are charged with the governance. So professional accountant is all those are members of the institute. Then he becomes aware of non-compliance or suspected non-compliance in relation to component of a group where the parent company is listed in India or the component is a listed entity. In either of the following two situations, he has to communicate the matters to the group engagement partner also, unless prohibited from doing so by law or regulation. And once it is communicated the group engagement partner, then he has to take care of that matter accordingly. And what further action after informing in the case of a listed company, if there's a group company, then to the group, then disclosing the matter to appropriate authority, and withdrawing from the engagement and professional relationship where permitted by law and regulation. So this is a point which I was talking to. Even if he has to withdraw, then he has to give the entire reason why he's withdrawing and why he's not willing to continue, and what are the issues, what are those suspected non-compliances of laws and regulations to the management, to those who are charged with the governance, and for the incoming auditor also when he's asked for the NOC. Then it also talks about whether he should be informing to the appropriate authority what he should be disclosing, how to determine what is to be disclosed. So there are certain specific paras which deals with that. And for the very important thing which this para mentions, and in fact I would like to suggest my professional colleagues to use them while looking at application of SA 250 also. So first of all, whether there is an appropriate authority that is able to receive the information and cause the matter to be investigated and action to be taken. This is the first point. Non-compliance is there, whether which authority is there, whether there exists robust and credible protection from civil, criminal or professional liability or retaliation afforded by legislation or regulation such as under whistleblowing legislation or regulation. So that is also important. If that is there, only then one should venture into going into informing. And third, whether there are actual or potential threats to the physical safety of the professional accountant or other individuals. That is also very important. I mean, all these aspects are also required to be considered before, but again, don't take them as a shelter for not informing, but definitely consider them how those are to be considered. So finally, the applicability of 360, as this was announcement was made by Ethical Standard Board on 29 September, that this would be applicable from 1st October 2022 with certain amendments. For the time being, it has been made applicable to listed companies, and having net worth of 250 crores or more. And it is mentioned there that subsequently it will be extended to all listed entities, for which the date will be notified later. So with this, I come to the end, and in fact, I have saved around 10-13 minutes for Q&A. So Anilji, you can take the question answer now.
Yes, sir. Thank you so much, sir. Can you hear me? Can you hear me, sir?
Yeah, please.
Thank you so much, sir, for such a wonderful and detailed deliberation. I have received certain questions, sir. Sir, for trust audit, whether the statutory auditor is required to check taxation compliance in cases where tax audit is not applicable?
You see, SA 250 is talking about audit assignments. And audit assignments, if audit assignments are with respect to the any which has been assigned by, which is required to be done by any act, so then we say that this is an audit requirement, it's an audit assignment. And therefore, SA 250 would be applicable there. So first look at that the audit of trust is carried out under what regulations. If it is for a specific purpose, for example, if it is, let's say, only for the tax purposes, then it may not be applicable. Because if you remember that in the very beginning, I mentioned that assurance engagement in which the auditor is specifically engaged to test and report separately on compliance with specific laws and regulations. So if it is only a audit under the Income Tax Act and they ask for specific laws and regulations, then it is not a audit from that point of view, which is the audit, let's say, for example, the audit under the Companies Act. So therefore, SA 250 would not apply there. This is my personal opinion.
Yes, yes. Sir, as you summarize that it's difficult to collect admissible evidence of the board, those charged with the governance involvement in non-compliance, misreporting and fraud. How best can an auditor safeguard his reporting when there are red flags but no hard evidence relating to the TCWs?
You see, first of all, we reach to that stage only once the auditor has at least auditor is convinced that there is a suspected non-compliance, or there is a direct. If there is a non-compliance, then there is no issue at all. But if this situation arises only when he's suspecting that there is a non-compliance, and in that particular situation, he has to make, as I think I have made it a very detailed explanation there. Then he has to first ask the management if they can help, fine. Otherwise, he can also take a legal advice from outside that whether this will tantamount, whether this will lead to that type of non-compliance would lead to material misstatement. He has to arrive at that either by discussing with the management, with discussing with those who are charged with the governance, or take a legal opinion. If some further evidence comes to him, then he can take the decision accordingly. And if he is not in a position to take any of this particular further evidence, then I think straightaway 705 will help. Then he has to take refuge of SA 705, which very by way of examples, which explains all the three situations: when he has to give a qualified report, when he has to give a adverse remark and adverse report, and when he has to give a disclaimer. So I would say that once after making all these aspects, if you are clear that there is a non-compliance, then there is no further issue. This issue comes only when there is a suspected non-compliance. So for that, take advice, take outside advice, consult, or first take the help of the management, ask them to explain, and then evaluate it. Even after that, go as per SA 705.
Yes. So what if there is a difference of opinion regarding some legal evaluation between auditor and management? How should auditor deal with these situations?
You see, once again, if difference of opinion means if auditor has arrived at a particular conclusion and management, then in most of these cases, which I have in practically we have seen, that auditor is always giving a qualification and management is explaining that through whatever, through his report in the board's report and all that. Then they explain through that. And in the case of PSUs, you have seen those number of such examples where observations has been raised by CAG, and then those explanation are given by the management. So on similar lines, this issue, if auditor is convinced and he is not able to get convinced by the management's explanation, then he has no choice. Rather, he should not take any other route but to qualify the report.
Yes, sir.
Their practical approach can be that management may be asked to put a explanatory note in their financial statement, and then he can, along with his qualification, he can also report that, refer to that particular note, so that whosoever reading the non-compliance can also look into the other aspect of management.
Sir, if professional tax sum of one state is remitted to another state, professional tax office, if the auditor does not manage to find it during the audit, does that amount to non-consideration of professional tax laws of these two states?
Nehalji, question is not very clear. Professional tax.
Sir, I hope. So the member is saying, if professional tax sum of one state is remitted to another state professional tax office, if the auditor does not manage to find it during the audit, does the amount of non-consideration of professional tax laws of the two states?
See, first of all, I don't know what is that, in which reference this query is there, but let me tell you what I have understood. So some professional tax has been deposited in office of a particular state, and which has now been transferred to professional tax office of the other state, and the other state is not confirming the receipt of that. I think that, if that is the question.
Sir, I hope there is a little bit confusion in the question. Incomplete question is there. I'll ask the member, then I forward it to you, sir.
Please, that would be better. Yeah.
Yes, sir. So one member is saying most companies do not issue a stamped receipt in case of the online receipts by RTCGS or NEFT. Are stamped receipts required? What is the compliance in this regard?
You see, again, it is a non-compliance, definitely, because if you look at Stamp Act and Stamp Act, then there are state stamp duty acts are also there. So if now one has to look at the materiality aspect also, because as I mentioned to you that the entire SA 250 is onto the material impact. So if it is the amount is small and looking into the entire this thing, then the auditor, let's take another case. In the case of a mergers and amalgamations, some duty is payable on transferring of immovable asset from transfer company to transferee company, and that has not been paid. And if the amount is big enough, is reasonably substantial, then that definitely will become a part of non-compliance and has to be reported by the auditor.
Yes, sir. So one member is saying there are more than 250 laws, like labor laws and other laws. So kindly elaborate while taking care of this, which laws we should cover, means while taking into account this essay. So which laws we have to cover into account, or what are the laws required to consider in this in the financial statement?
I think once again, with this question, I feel that it means my deliberations were not successful. I couldn't convey to him properly. See, I mentioned it very clearly, and SA 250 is very clear on that let us divide the laws and regulations into two parts. First category are those laws which are, so out of that 150 laws or 250 laws which is referring to, look at those laws which are which becomes the regulatory framework. So that is one part. So those has to be considered. Then second is all those laws and regulations where which has material impact, And then third is non-compliance of that, of any law has material effect on the financial statement. For example, which I gave was about the FEMA related matters. If a company is into, let's say, dealing in a foreign exchange dealing is there, then those regular transactions are there. If you look at purely from accounting point of view, but if it has not been done according to the law of the land, which is the FEMA regulations, then they may lead to the penalties or imposition of fees. And so those, if those are bigger enough, are material, then those aspects are also. So some of them are very clear that, for example, tax, income tax, then you see all the labor laws, then MSNE, both specifically, since it is specifically mentioned. These are some of the, I mean, please don't take it that way. I'm just telling you this only 4 or 5. It has to be seen on case-to-case basis. First, look at the business environment in which the company operates, the industry in which operates. What are the regulations which apply to them? Let's take a case of a tannery. Tannery, we can say that they are manufacturers, they are processors. But if you look at from tannery point of view, the most important law which is applicable to them is pollution. See, so all the pollution related laws will become important for them. And so that is the way you have to select out of those 150 or 250, what are those which are actually more relevant to this particular entity, and accordingly take a call. Then automatically you will get, in the process, you will eliminate them. And most important is, no business is run without compliance of laws and regulations. So every business must have they always have a list of laws. It's only that auditor has to make an inquiry. I mean, I have seen in number of companies, when you go to audit committee, the very first thing which is asked is, let us look at various laws which are applicable to the companies, and let us look at how company has complied with, what are the rules and regulations. So that information will also be coming from the company side to you, that what are those and then sometime, as I think it was mentioned there also, in the routine audit also, sometime you will identify why this legal case. For example, this Benami Property Act or Black Money Act. All this time, sometimes you catch them through a indirect evidence which is coming from, let's say, from the legal fees or professional charges which has been paid to lawyers to deal with those cases. And accordingly, then you can identify them and then assess whether they have any material impact on the financial statements.
Yes. Sir, to more compliance question, one member is saying whether late filing of accounts with MCA to be considered as non-compliance.
Yes, non-compliance in the sense that if it is a non-compliance which may convert the company into inactive company, then it is something different. But if it is, let's say, 1 or 2 months, then it is though it is a non-compliance, but of insignificant importance. It has to be seen on case-to-case basis.
Yes, sir. So second last question. In case contractual terms with MSNE, vendors are not in agreement with MSNE Act, and companies saying that no interest is to be paid based on the contractual terms, then what disclosure is to be made in financial statements? Still, interest is to be provided in such cases? Yes,
without fail. I'll tell you, it is very clear in the Act itself. It is mentioned that the personal contract or mutual understanding has no relevance. 45 days means 45 days. The party may agree to a different terms. Still, this section 15 to 17 will trigger, and accordingly, interest has to be provided for.
The last question. There might be instances when the auditor is not informed about the non-compliance with economic offences, or it does not come to his knowledge as part of the audit procedure.
Right.
The auditor might have carried out due diligence, however, it does not come to his knowledge. What are the implications on the auditor? Can he be sued by the investor even though there was no negligence on his part?
No. See, this logic goes with any standard. But I'm trying to say that if your audit file, your working papers can establish that you have done whatever is required to be done with respect to SA 250, with regard to audit evidence, with regard to confirmations or whatever, all that, in spite of all that, you have, let's say, complied with, and nothing has come to your knowledge, only then this will save you. Otherwise not. You see, first of all, if you have taken, let's say, written confirmation, what are the laws which are applicable to you from the company, and you have also taken some external additional audit procedures to verify that whether the explanation which is given by the company are correct. So those are some of the working papers will tell you, will establish that you have taken due care of all that. And after that, if it has not happened, then of course those audit papers, there are a number of judgments where auditors were saved because of their this audit pre or post audit exercises which they have carried out, and where they could establish that they have done what was required to be done as per the various essays.
Yes, sir. Sir, thank you so much, sir. Now we have come to end. It was really wonderful to have your expert knowledge over here, sir. I have gained a lot through your deliberation, and it was in a very detailed and a very lucid manner, sir. On behalf of AASB of ICI, once again I extend my heartiest thanks towards you, sir, for sparing your valuable time. In spite of having very busy schedule and so many meetings, you have acceded to our request. Thank you so much, sir. Thank you so much, sir.
Thank you, Anil. It was a pleasure to be part of this.
Thank you, sir. Thank you, sir. Thank you, sir. Namaste.